Chapter 7, Fixed and Intangible. So what is a fixed asset? It exists physically. So land, machinery, buildings, trucks, this all exists physically. It's tangible. You can see it. It's physical. They're owned and used by the company in normal operations. So land, a building, machinery, that's all used by the company in its normal operations. So if you're a manufacturing company, a stamping machine, a factory, land, that's all used in your normal operations to make something. And it's not offered for sale as part of the normal operation. So you can sell your fixed asset, but your principal way of business isn't selling fixed assets. So trucks, under our manufacturing example, is a fixed asset. But if you're a truck dealership, those wouldn't necessarily be fixed assets. The trucks would be inventory because you're selling them. This is a big number on the balance sheet. So if we look at ExxonMobil, for instance, fixed assets are 66% of the total assets on the balance sheet. So this is a big number. It gets a lot of exposure. So when we buy something, here's a little decision tree on how we treat it. So first thing we ask ourselves is if what we're purchasing, is it long-lived? If it's no, then it's an expense on the income statement. If yes, we go to step 2 and ask ourselves if the asset's used in normal operations. The answer is yes, we have a fixed asset on our balance sheet. If it's no, we have an investment on our balance sheet. So when we acquire fixed assets, and 2 examples here are land and buildings, we're going to create a land account on our balance sheet under assets, a building account on our balance sheet under assets. But you see a number for land. What is included in that number that we see on the balance sheet? Well, we see its purchase price, sales taxes, and the other items down the line goes into the land number on the balance sheet. And the same with building. You see a building number on the balance sheet under assets. This is what's included in that number. A couple more examples. So first we see a line item on our balance sheet under assets called machinery and equipment. What's in that number? Sales taxes, freight, installation, everything down the line. Another type of fixed asset is land improvements. You see an item on the balance sheet under assets called land improvements. Well, what's in that number? Trees, parking areas, lighting, fences. So we have 2 different expenditures we can make. We can make a capital expenditure, or we can make a revenue expenditure. Capital expenditures go onto the balance sheet and increase the value of our fixed assets. So capital expenditure asset improvements and benefit current and future periods. And we would increase the fixed assets. So if we have a truck, we replace the engine, that's an asset improvement. It benefits the current and future periods. So we would increase our fixed asset number on the balance sheet by the $2,000 or whatever it costs to put the new engine in. Our revenue expenditure is ordinary repairs and maintenance. So this would be on our truck, we get a $20 oil change. That's an ordinary repair and maintenance. So that would go under expense on our income statement. It would not go under fixed assets on our balance sheet. So that's the difference. A capital expenditure goes on our balance sheet and increases the value of the fixed asset. A revenue expenditure goes on our income statement under repair and maintenance expense. So here's another decision tree. So we have a cost. If it benefits only the current period, it's a revenue expenditure. It goes on the income statement under ordinary repairs and maintenance. If it benefits future periods, we could say it's a capital expenditure. So if it's an asset improvement, we add service value to the asset, we increase the fixed asset in purple. If it's an extraordinary repair that extends the asset's useful life, we would decrease accumulated depreciation.